Okay, so welcome back again to MBAbullshit.com. So the topic for this video is EPS, earnings per share, which is one of the market value measures, or actually could also be a profitability measure, depending on what book or which professor you're talking to. Or it could be both. Let's just say it's both. Alright, so remember you can always go back to MBAbullshit.com. Alright, so this video discusses one of my free videos on liquidity, profitability, and market value, which include these ratios over here. Alright? And after these, you can check out my next videos in MBAbullshit.com, such as my video on financial leverage ratios, and that video includes all of these ratios over here. And you can also check out my other video on MBAbullshit.com on turnover ratios, and that video includes all of these ratios over here. Okay, so let's get down to it. Now let's start with a story. Let's say that ABC Company's net income last year, okay, is $1,000 and there are 100 shares outstanding. What is its earnings per share? Very simple. Now outstanding means how many shares. Well, never mind. That's not the focus of this video. Like I said, you should already understand the terms and stuff on financial statements. I'd like to keep this video as short as possible. What is its earnings per share? Well, it's super simple. Earnings per share is simply the total net income last year of the whole company, alright, divided by the number of shares outstanding. Okay? Number of shares outstanding. Now, if you do this equation, you'll find that the earnings per share is exactly $10. A nice, simple, easy round number. Now, this is the most easy part of financial ratios, which is to compute the actual number. What's more important is, what does this mean? Okay, this means that every share earns $10 a year in profit. Well, or last year, every share earned $10 a year in profit, meaning you get the whole profit of the company and you divide that by the total number of shares. Then every shareholder, okay, assuming each shareholder owns only one share, which is not really the case, but assuming every shareholder owns exactly one share, then every shareholder gets $10 a year in profit. Now, I'd like to stress that this is $10 a year in profit, not in dividends. Okay, if you remember, well, I don't. You should know that by now, but if you don't, that's okay. Remember that when the company earns profit, okay, it's supposed to share that profit or remit or give that profit back to the owners or back to the shareholders in the form of dividends. Now, how much does the company pay back to the owners in dividends? They could pay all of the profits to the owners in dividends, or the company might keep some of the profits inside the company and only use some of the profits to give to the owners as dividends. So every share, in this case, when we compute the EPS or earnings per share, okay, we talk about the profit per share or the earnings per share, not the actual dividends that the company eventually decides to pay to the shareholders. Okay, so is a high earnings per share good or bad? Well, generally, a low earnings per share is bad because it means less earnings or money for the shareholders. A high earnings per share is good because it means more earnings and money for shareholders. Now, there is a major flaw with this ratio, which is that the earnings per share is a very incomplete indicator. It doesn't take into account the price of the stock or the owner's investment. Now, what do I mean by this? Do you prefer an earnings per share of, let's say you own part of a company. Do you prefer an earnings per share of $100 or $1? Of course, you would say $100. But what if you had to pay $1 million for one share, and then it had an earnings per share of only $100? Okay? Or what if you paid only $2 for a share of stock, and then it had an earnings per share of $1? As you can see here, you would prefer this one instead of this. Okay? You invest only $2, then you get $1 in earnings. But in this first case, sure, you get $100 in earnings, but you had to pay $1 million for that share of stock. So it's a much better deal to get this one, even if it has a lower earnings per share. Okay? So obviously we choose the second one. So how do we analyze this traditionally? First is to compare the historical earnings per share of your company or of this company. So that maybe it's not your company, maybe you're thinking about investing in it. If the earnings per share is higher now than last year's, then it indicates that the company is more profitable than before. Now I stress, and if the earnings per share is lower than last year's, then it indicates that the company is less profitable than before. Now, I say there's a very important caveat here. Alright, there's a very important thing to take note of. This only works if your company has not had any stock splits, stock dividends, or share purchases, or things like that. Because if your company has had, for example, that complicates the situation, put it this way. Because maybe your shares outstanding, how do I explain this in an easy way? Well, I do have another video on stock splits and stock dividends and share repurchases. I highly recommend you watch that. But for now, just take it, I recommend you watch that. And let's just say, because it's not so simple, okay? There's that's a whole video in itself, explaining what happens to dividends, etc., when there are stock splits and stock dividends. Because when there's a stock split, your one share can suddenly become 2 shares, okay? Or there's a share repurchase, your 2 shares might, the value of 2 shares might merge into just one bigger value share and things like that. So if you didn't understand what I just said, then please do watch my other video on dividend policy. Okay. The second way of analyzing, so I forgot that I actually put that in this slide. Watch my other videos. Anyway, the second way of analyzing this is to compare the earnings per share of this company to other similar companies. Oops, but that's actually not really a good thing to do, I think. And why? Because when you compare a ratio to other similar companies, that's okay. But in this case, when you compare earnings per share to other similar companies, this will only work, or this will only make sense, if the market price per share is exactly the same for similar companies, or if the equity per share is exactly the same for similar companies. But that never happens, okay? That never happens. The market price per share of Walmart is never exactly the same as the market price per share of Walmart is never exactly the same as the market price per share of Target at the same time, okay? So therefore, I would not really recommend using this type of analysis for the earnings per share. So instead of this, it's better to use the PE ratio, or the price earnings ratio, instead. And that one, you can compare the different price earnings ratios of different companies. Now, you can watch my other free video on the price earnings ratio. Alright, so that's it for now. I hope you learned something. Remember to share us if you like us. Share it if you like it. Follow me on Twitter at MBA Bullshit. And please join my fan page on Facebook, facebook.com/MBA Bullshit for the latest updates on my latest video. And simply please forward my YouTube links on your email or your other social media. So have a great day and goodbye.